Hey guys, Seeney here, and welcome to the Australian Wealth channel, where we talk about personal finance, the stock market, real estate investing, and just getting to a place where you can live a life that is financially successful. So today we are going to be talking about the biggest mistakes I see in the stock market. Okay, so these are some of the biggest mistakes that I see in the stock market. Now, these are the top 5. I guarantee there's a lot more things that can go wrong when you invest in the stock market, but I think these are the 5 main ones that people seem to have a lot of trouble with, because especially when you're first starting out as an investor, it can be quite difficult to know what to actually do when you're investing in the stock market. So all of this information that I give, of course, is just entertainment. I don't know your specific circumstances, so you need to speak to someone to talk about your specific circumstances, but I found that these are the things that I've noticed that seem like really big mistakes. Right, now the very first one is time in the market versus trying to time the market. So Warren Buffett is obviously the greatest investor of all time, has managed to amass billions of dollars just through his investing in various companies. And this is one of the big things that he mentions, is that, time in the market is always going to beat trying to time the market. And that is very true. There's many times throughout history where it's looked like that the stock market has been quite overvalued, but lo and behold, the stock market continues to go up and up and up. And if you try to time the market and you go, okay, well, I'm just gonna wait until it crashes, then chances are you're gonna be missing out on a lot of gains. So the thing is, you put your money in and it goes down. Like, okay, that happens quite a bit. It's a 50-50 chance. It can either go up or it can go down. But the thing is, when it goes down, you're getting what you thought was a good deal at an even better deal. So as the market continues to drop, then, you should load in some more cash. Well, at least that's what I do. I try and load in a little more cash as the market continues to drop. So I've found for myself, continually investing has been the way to go. And then when those dips do turn up, it's a great time to take further advantage of them. One of the biggest stock market mistakes that I see is not smashing the like button and hitting subscribe. It really helps out the channel, helps it get seen by a lot more people. So if you could like, subscribe, and leave a comment, then that would be fantastic. Okay, so number 2 of the biggest stock market mistakes is dumping all of your money in at once. Now this, I don't think, is a great idea. I do not just put an entire position into the market pretty much straight away, because you don't know if the stock's gonna continue to go down. I'm usually looking for stocks that have come down quite significantly in price. Now the thing is, if you look at a stock like Facebook and you see, oh, it's at $200, that seems like a decent deal, and you load all your money in, and then the stock continues to drop 180, 160, you've got nothing left to invest. You can't average down your costs. So if you thought Facebook was a good deal at 200, then I bet you think that Facebook was gonna be an even better deal at $160 a share. And the thing is, you're not gonna have any money to be able to get hold of that great deal. So it's really important that when you're investing, you're always averaging into a position. Okay, now number 3 of the biggest stock market mistakes that I have seen out there is not staying within your circle of competence. Now, what is your circle of competence? Now, that's basically everything that you kind of know about. See, for myself, I have a deep understanding of technology, memory, and marketing, and a few other areas. So for me, it makes a lot of sense for me to invest in companies that are within that circle of competence. If you're a data guy and you know lots about computers, then maybe tech is the right space for you. But if you know a lot about distribution chains, maybe Amazon's a good play for you. But it's really important that you fully understand what you are investing in. So many people just throw money into something that they have absolutely no idea about. And that is the place where you're probably going to lose a lot of money, because to invest in a company, you need to fully understand the business. How do they make their money? What are their expenses? What's their growth going to be like in the future? If you don't have a deep understanding of everything that business does, then it's really hard to see where that business is going to go in the future. So your circle of competence is something that is incredibly important. It's something that Warren Buffett always advocates for. And I think he's 100% right there, because he invests completely in companies that he has a very good understanding of. And this has led to incredible returns for him. Now, of course, there are opportunities that will be outside of your circle of competence that you will miss. And look, that's fine. There's opportunities that come up all the time in the stock market. But if you're not knowing what that business is doing, then it's not a good idea, I don't think. Okay, number 4 of the biggest stock market mistakes that I see is asset allocation. So many people, when they're investing, they end up going way too heavy in one particular sector. Now, I understand that like from a circle of competence perspective, but I think when you're investing, it's really important to have a few of these circles that you're working on, so that if one sector gets completely slammed, then you're not going to lose a ton of money. For example, if you're completely invested in the memory sector and that's all you do, then if memory prices happen to go down, then you're going to end up in a lot of trouble and those stock prices are going to get crushed. However, if you have a little bit of memory, you have a little bit on the marketing side, you have a play in e-commerce, then you're going to be much more protected against the downside if one of those things ends up getting crushed. Now, on the other side of that, if you're completely and heavily invested in memory and it all goes up, then that's great. But of course, that will increase your risk being exposed just to one sector. And when you're trying to build wealth in the long term, it's very important that you do manage that risk. So I've done it myself. I've had way too heavy positioning in particular stocks. And of course, what happens is memory prices slide, consumer demand falls, then some of these sectors tend to get crushed quite a bit. So it's really important that you're paying attention to your asset allocation as well as staying within your circle of competence. Okay, and the final mistake, number 5 for the biggest stock market mistakes that I see, is buying overvalued companies. Now, there are a lot of fantastic companies out there that are doing incredible numbers and will continue to grow in the future. Facebook, for example, is going to continue to do great numbers and continue to grow as the entire world moves more to the online space. Do you think I'm going to be buying Facebook at over $230? Not a chance. It is way too expensive. I don't care how good the company is. If it is overvalued, in the long term, you are killing your returns. I don't care how good the company is. Over the long term, if you're buying a company that's overvalued, it's going to kill your returns compared to getting something that is at a much more reasonable price, which is a great business. See, for me, I won't be buying Facebook anywhere near $230 a share. If I see it go under 180, 160, then yes, I will start building a position. Now, many people advocate for buying companies at basically any price. That's not what I do. Based on a lot of the looking that I've done, it really debilitates your returns. So I think it's best to have a look in the market and see where those great opportunities are. Like, for example, I think Shopify is a fantastic company, but I've seen the share price go from $150 a share, or even lower, $90 a share, all the way up to over $800 a share. And the valuation of that is insane. And who knows, it could continue to go up. And you know, it probably will. But the valuation, when people realize that the growth rate is starting to slow down on that company, then the stock price is going to get destroyed. So the best thing that you can do is find companies that have great growth ahead of them, are moving into really exciting industries that you understand, and are at a market value that is much more reasonable. I tend to look for companies with a forward PE of under 15 in case of a value stock. And depending on what the growth rate is, maybe if a company's growing at 20, 25% a year, I'll be trying to get them at a forward PE under 20 or 25. Sometimes you can't always get that. I would love to build a position in Nvidia, but of course the stock price is too high. So you need to be really disciplined there and look for those companies that aren't overvalued, because there comes time in the market where those opportunities do appear. And when those opportunities do appear, it's great to be able to pick them up. So I hope that you really enjoyed these 5 biggest stock market mistakes. I see them quite a bit, and they're mistakes that I try and avoid so I can get myself great returns in the future. I hope that they help you. If you enjoyed this video, make sure you like and subscribe. And if you have a comment about what you think is the biggest stock market mistake, then I would love to hear it. So thank you guys so much for watching, and we'll see you later.